The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Hello there, and welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear.
Hi there, George. It's been a few weeks since we last spoke. A few things have happened in and around the market, but perhaps not as eventful as we might have feared. The big boys over in the US have been reporting, and we were all looking forward to sort of more evidence of what's happening with AI. Yes, they are spending more money, $200 billion or so this year, looks like going out from the likes of Microsoft, Meta, Amazon and Google. And most of that is CapEx on data centers, and therefore if it's on data centers, it means it's AI. But really, although they're talking about cost savings here and there, benefits for them, benefits for customers coming in and doing things, there's not really much in the way of returns, although what they are talking about in terms of returns is still in the billions of dollars. So it's a little bit sort of sit back and wait there, although it has to be said that in the meantime, the media is getting hold of the story and trying to rattle the cage of AI and try and find what's going on underneath the surface. The FT, I think, is doing a particularly brave job looking at what is described as the neo-cloud, the specialist AI guys, pointing at where these guys really getting their money, what are they promising to customers, how sustainable is their business model. And their favourite one to pick on is CoreWeave in particular. It's only so long that this sort of story can run without some kind of evidence coming through of where the returns are going to be. But I don't really see anything that the FT is talking about there that's any different to what it was 20 odd years ago when we saw the telecom companies investing heavily. But one thing that has sort of gained some traction is Supermicro, which is the specialist server maker. Servers for AI applications, one of NVIDIA's biggest customers. That has gone marginally wrong at the moment. Hindenburg Research have published some reports into accounting manipulation, the usual history that we have with Hindenburg, targets of self-dealing with related parties. The auditors have resigned, and I think this is going to be an interesting theme over the coming months where people try and shake the cage, try and find something wrong, but I can't really at the moment see anything wrong with AI in terms of actually disproving, which makes it a bit difficult.
Ian, don't think that much of this relates back to the life cycle in terms of AI. So in terms of the noise coming through from companies, we're still at that sort of proof of concept stage. The good news is that the next stage in terms of inference, where there should be a much stronger visible ROI, is that will drive even more demand on the server side. I still think we're early days in terms of the impact of the new technology. But where do you think AI is on the hype cycle?
It depends on which population we're talking about. I don't think it's got there as far as what could be described as the popular press. As I was alluding to there, the financial press is desperate to get ahead of it and is in there telling the grumpy stories and trying to find something to get themselves some column inches.
But also classically, this is one of the signposts for a technology theme, which is getting into the trough, and that is being kicked in there by the trade press and the financial press. So I look on it actually as a positive in terms of the evolution of Gen AI. Simply, it can only get better as it falls into the trough.
Yes, I think once we're aware of the problems and once we're aware of what's going to go wrong, it's no longer being talked about as the miracle for this and the miracle for that. We can talk about it in more realistic terms. Quite what that does to certain companies' valuations is another question. I think in terms of the people using tech day to day, it is permeating. People are understanding. People are also getting their heads around the fact that we're not there yet in terms of customers coming out to say, I want this AI product, I want that AI product. A lot of it is people sitting down with their customers and say, well, maybe we could solve this problem with AI, maybe we could do that, maybe we could do this. It's a question of people beginning to feel comfortable with it, should we say, rather than throwing themselves full blown onto the AI sword. Maybe that is the way we are going to go about this.
And that will be post-trough. But really, I guess what you're saying is that as we try to map the development of AI, to still look at the hardware side.
Yes, we can't get away from that, and we can't get away from what hardware is as a business. There's still a risk of some hard knocks coming our way, which might be unpleasant for NVIDIA shareholders. But long term, the story's still there.
I was going to say, and they'll probably come up with a cracking print, because if there's anything there is they have this unassailable lead. And I still think we're at POC, which means training models rather than inferencing, and they still have that great lead there. So I would say we have another good print coming down the pipeline. Now, what I don't know is how massive the whisper word is on the street. And I was going to say NVIDIA is the 20th of November, but I think I've been saying that to myself for a while. I need to check that.
Well, will people be surprised by what they report? Will there be upgrades? There weren't surprises and upgrades a few weeks ago. I would have thought the communication channels are there for us to have an idea of what's really going on. I don't get any idea that they're playing games anymore. What value is there to playing games anymore if you're just putting yourself out there to be hit if you just try and play the beat and raised game anymore, even as they have done that for the last 30 years.
So I was going to say, but they have been doing that consistently through this early cycle.
Well, having said they've done beat and raised for 30 years, they've also done miss and cut for 30 years as well.
So they have.
What else has been going on for you? What have you been looking at?
Like you, stuck in the weeds in Q3 in terms of the tech reporting cycle. Software's on a complete roll. They're all coming out with beat and raises. As I look closer into the UK, we had the budget. The budget was seen as a positive for AIM. So if you recall on the day, AIM was up sort of 3%. But then following the UK budget, we had, of course, the US election. And from that, very strong signals coming out of America, whereby American institutional investors who've been buyers of UK tech this year, they suddenly found a reason to go back home with tax cuts for US companies. So the idea being that earnings, positive surprises as Trump rolls out his domestic agenda. So that was a real shame in terms of the UK. So what we've saw is that UK shares rallied on our budget, but then gave up the gain as the Americans started to go back home. So sector TSR is now up a paltry 2% year to date. At the same time, numbers have been okay. The big surprise was we had a warning from Kainos. So it's a professional services supplier, about 3,000 billable FTEs in the company, sort of most famous for digital transformation service into UK public sector. However, as we've been watching through this year, UK public sector usually goes through a purdah period, so they tend not to buy in and around the election and in the immediate aftermath. So you expect sort of, poor news, and they've been delivering on that. So they had a profits warning about 2 weeks ago. And then earlier this week, they had interim results, and interim results basically brought home the decline in spend in public sector. So one of the issues for them now is that their commercial side, it's at 53% of revenue in its a blended business, as you know. So they've got a software development group that's just over 18% of revenue. That's been going like gangbusters.
This is the Workday.
Yes, absolutely. Yes, this is the Workday business. So basically, they develop the apps that Workday couldn't be bothered. So Workday, as you know, is really in two areas. It's in financials and it's in employee management. And the guys at Kainos have 5 software products which they sell into the Workday install base. So anyway, so revenue up there, up 28% year on year. The challenge with the business is on the implementation services side, both on Workday services, that's 24% of revenue, and on the mainstay, which is general digital transformation, of which the big customer is UK public sector. Now, for lots of investors, the general view is that it will come together again as UK public sector spends, and that'll be into next year. The only issue, though, is that now that they're doing more than 50% of revenue in the commercial market, suddenly their pricing model starts to become a little bit of an annoyance.
Are these the same people on both sides of DX?
Absolutely. You go through a training boot camp, but in fairness, software engineers are used to doing that anyway. But the issue is that the commercial market is having better pricing in terms of IT services. But also, if you look at the global suppliers, their skills bench, they have this sort of pyramid model based on two things. One is your technical skills, but secondly is your underlying economics. And these companies have a global blended delivery model. Kainos doesn't. So because of that, Kainos will be charging twice what, say, an Indian offshore company could offer. And where you've got a sort of still a difficult economic backdrop, you can say, well, improving in parts, yes, but nonetheless, no one sort of released the budget. Person said, yay, spending time. So they are exposed there on the back of their delivery model. So what they need to be thinking about is how do they make it cheaper? And you can make it cheaper by going to the likes of Sofia, i.e. Eastern European pricing, or doing a better job in India. They've had 200 people in India. That would be out of, 3,000. But they need to work that blended delivery model a lot more aggressively. And if I was in there, I'd be saying, think about M&A. Now, at the same time, in terms of their public sector market, I'm sure you spotted, Ian, that you had positive statements both from TPX Impact and Triad. So really telling us that small companies, and for small Triad, is 130 billable staff in there, so it's not large at all. But they have been coming out with more positive statements suggesting that the purdah period in UK public sector is coming to a close.
Are Kainos exposed to larger contracts? Are they sitting on bigger orders to be placed and therefore greater delays and greater questions within Whitehall?
Absolutely correct. Greater delay, greater scrutiny, just bigger brings that as an issue, yes.
And when you say acquisition, how would the acquisition work? Is this an acquisition within the UK, within Europe, or maybe on a wider scheme?
Ian, sit back, close your eyes. Let me take you back to the 1990s. A company called Zanza, it was called FI at the time, acquired a company called IIS in India. So you acquire out there, and that's what gets you the heads. You can say, George, hang on, you can grow a team quite quickly, but if you really want to make a change, I think you go and you make an acquisition. And these companies are still cheap because they're all still priced at trough valuations. So that would be my approach, would be to buy something, get critical mass, and really sort of change your pricing model to your consumers, i.e. UK citizenry. Now, at the same time, from the print just yesterday, what they said they would do is do a share buyback. And you can say, George, the only consistent buyer of UK stocks this year has been the companies themselves, that they're also doing that. So they've earmarked 30 million for it. But for me, I would say, yeah, fine, you've made that decision. Now use the rest. The company has 150 million. Use the rest, M&A, somewhere to change your economic. It doesn't have to be India. It could be the Philippines. It could be Eastern Europe. But start to deliver better pricing to your end customers.
So it has to take a step forward rather than sit and buy back shares.
That would absolutely be my view. But otherwise, that was sort of the highlight in terms of UK tech. But at the same time, I've also seen Martin at S4 Capital and also the team at Team Internet. They're in the sort of the general ad tech world, and sort of poor news coming out from both of them. And that was the first time that Team Internet warned. So that was pretty disappointing. However, both of those are close enough to a company I know you've been thinking about in Digital.
Digital is a lot easier to get your head around than either S4 Capital or Team Internet. It's the company that does customer engagement and experience software. the mailings in and out, who's doing what, who's said what, who's seen what. It's an interesting business. It used to be very, very sexy, and then everyone realised that it's actually just a lot of simple things plugged together. But plugging a lot of simple things together makes it a complicated thing, and complicated things need some customer service. So it's actually a nice platform of products that sells into the marketing department of companies, and because it sells into marketing departments, it's not quite the sort of heavy lift that many bits of software are that we see on the market. It's got some good margins, 30-odd% EBITDA, high teens growth rates. It is a rule of 40 company for those who worship at that altar. So it's a great story, but then we take that horrible sort of back step and we start thinking, well, actually, what does it look like from a global standpoint? You know, I put on the cynic's hat and I go and see that Klaviyo has got mid-teens margins, which is a big US competitor, but it's doing 30% growth. It's spending the same on R&D. In fact, it's spending more on R&D per year than Digital is generating in revenues. And then I can look at what's happening in Asia Pacific, where it's growing strongly at the moment. And there's a particular player there called Insider. They've got around $200 million of recurring revenue. And they've just done a Series E raise. In old school money, that would be called an IPO, or actually a secondary fundraise. And they've done that $500 million. It's quite difficult when you look at companies like that and thinking, what a brave little soul Digital is. And I find it difficult going backwards and forwards thinking, should we be investing in this? Should we be telling investors to invest in this against those kinds of odds? And then you think, well, actually, it's always come through this business. It is doing those margins. It is managing to deliver that kind of growth. It's not going to be the biggest player in the world, but frankly, most companies aren't. What we're looking at is trying to make money for shareholders, not back the biggest company or the best company.
Not to sound like an apologist for them, Ian, they acquired a little company called Fresh Reliance just over a year ago. Fresh Reliance was a cracking little business stuffed with a C-suite who really knew what they were doing in e-marketing. So what they have done is acquired R&D, so they got that one right. My only concern there is that the guys in Fresh Reliance, the sort of the founding team, for them it was more of a retirement package. So I don't know if they've stayed to continue to drive the business. But that was something I thought Digital did really well, actually. Get somebody else's R&D.
Yes, and putting the cynic hat back on again. The R&D, I mean, to what extent is R&D in these companies just like advertising spend? You think 50% of it's probably wasted anyway. A lot of these things are coming requests. Oh, I've got to do this. It doesn't work. I can do that. It doesn't work. Sometimes these things are done for customers or because people see an opportunity and they just don't work. And it's just like advertising.
Speaking of just like advertising, actually, here's two thoughts for you. There was lots of chat about IPOs that were to happen in H2, and that was following on from Raspberry Pi, which was a huge success as an IPO. I always remember my old boss, Tim Lineker, telling me that the success of an IPO is not on day one, but it's on the year afterwards. And with that, I don't know if you spotted on it last Friday, sort of crept out. Fidel Partners. That was an IPO from last year. We only had a few IPOs last year, Fidel being one, Cab Payments another, Tribe Technology being the other. All three of them have now. So you've got the full suite there. They've all warned. As a cohort, they are now 65% below the issue price. And then the other thing was a positive note. So as we think about a sort of tech economy and the underlying inputs, if we look at our day rates that we've been monitoring, in November, the rate for contractors was up. Now, it was up 0.3% sequentially. However, that's the first time in 5 quarters that that was up. A rare piece of good news. Now, at the same time, if we look at the year on year and year to date, sadly, the rates for both contractors and for full-time staff are down substantially on 23. But I thought I would leave you on a little bit of a positive in terms of our input pricing in the tech sector.
Are these contractors returning to the market having gone away for AI training?
Not specified. Not specified.
Well, thanks, George. That's been great.
Lovely to chat, Ian, as always. Best of luck for the week ahead.
And you. Cheers.
Brought to you by Progressive Equity.